How does a bench-warming NBA player do against amateur challengers on the court? And if we transport that same idea to Wall Street, what results do we get when elite fund managers face off against challengers who know literally nothing about finance? We'll look at this today and uncover investing lessons for all of us. Cue the story music. Brian Scalabrine played basketball in the NBA for 11 seasons, from about 2001 to 2011. Now, on a highlight reel of the NBA's finest moments, you're not going to see much from Scalabrine. Like, not even a brief cameo. The truth is, he was not a starting player, and nothing about his playtime statistics is particularly impressive. What we want to highlight about Scalabrine is something that happened after his NBA career ended. You see, he kept playing in rec leagues and pickup games simply because he still likes playing basketball, and after talking about how he had put up 60 points in one game, a bunch of people took to Twitter to tell Scalabrine that he sucked and they were better than him. Internet people. Gotta love him. To which he basically said,
"Listen, I may suck for an NBA player. Like, those guys are pretty good, but I don't suck compared to you. Like, you suck compared to me. I suck compared to Derrick Rose and Russell Westbrook and those guys. So let's just do it."
And so the Scalenge was born, where 4 of these challengers in Boston got their wish to play one-on-one against Scalabrine. And you know what happened? Scalabrine utterly crushes their souls. The combined score of his games against these guys was 44-6. The takeaway here is that even though among the pros Scalabrine wasn't outstanding, anyone playing in the NBA is still good enough to have made it to the NBA. It's obvious that the gap between professional and amateur basketball is considerable. But what we want to look at now is if this same gap exists between the pros of Wall Street and their amateur challengers. In the 1980s, there was a recurring scalenge, if you will, that put elite fund managers up against, well, randomness. The contest was held as a recurring column called the Investment Dartboard in none other than the Wall Street Journal. The Investment Dartboard went like this. 4 professional fund managers, really rich people with fancy cars, got to choose one stock that they believed would have good returns over the next 6 months. The 4 stock picks from the pros formed a micro portfolio, which was compared then to their opponents. Who were their opponents, you ask? 4 ordinary people, usually folks who worked for the Wall Street Journal, who made their stock selections by throwing darts at the stock tables posted on the office walls. Whichever stock the dart hit became the pick, and these 4 dart throws formed a micro portfolio of random picks. After the 6 months, whichever micro portfolio provided the greatest return was declared the winner. Now take a moment and think about what the results here should be. On one side, we have seasoned professionals, years of experience, countless hours of research and knowledge of the nuances of public markets. Their fingers were on the pulse of the financial world. On the other side, we had, well, the opposite of that, randomness. The flutter of a dart in the air, its unpredictability representing pure chance with no strategy or reason behind its landing spot. The stakes were high. The pride and reputation of Wall Street's elite were on the line. Every 6 months, as the results approached, you could feel the tension. Would experience triumph, or would the winds of randomness sway the results in an unexpected direction? Well, after 14 years of doing this, and 142 individual competitions, the pros did outperform the darts. The fund managers were victorious in 87 of the 142 contests. But another way to put this is that stocks picked by pure chance outperformed professional fund managers almost 40% of the time. So how could this happen? And what does it mean for your investment strategy? Well, firstly, let's recognize that the Wall Street Journal's dartboard investment experiment isn't by any means a conclusive case against fund managers. After all, each fund manager could only pick one stock, in essence forcing them to commit to an all eggs in one basket approach, which they would never otherwise suggest. What the dartboard investment does give credence to, at least in my view, is the fact that hand selecting winning stocks is a very difficult thing to do. This is at least in part due to what is called the efficient market hypothesis, put forward by Princeton economics professor Burton Malkiel. In his book, A Random Walk Down Wall Street, Malkiel posits that any information available about a company is basically automatically reflected in its stock price, and that future changes in price rely on tomorrow's news. And since tomorrow's news is difficult to predict, so too must be the ability to predict changes in stock price. Basically, efficient financial markets generally do not let you earn above average returns, without accepting above average risks. Now, the efficient market hypothesis certainly has its critics, but I think it's difficult not to recognize its merits. So what are the takeaways here for most of us average Joes trying to grow our hard-earned cash? Well, number one would be that the next time you see an ad where Mr. Guru is going to let you buy his $1,000 course in which he'll teach you his secret investing strategy no one has discovered, well, maybe save your money for something more certain, like a lottery ticket. Takeaway number two, particularly for beginners and us average Joes, is to recognize that in efficient financial markets, it is difficult to consistently earn a return beyond what the market is averaging. But that's not to say that what the market is averaging, on a long-term basis at least, is a bad return. And that is why so many people, including the Oracle of Omaha himself, tout the benefits of holding low-cost index funds. You see, an index fund's aim is not to outperform the market, but rather to match the return of the index it follows. The S&P 500 is one such index that tracks the performance of the 500 largest publicly traded companies in the US. So rather than go out and buy stock in each of these 500 companies, you can purchase shares in an S&P 500 index fund and mirror similar performance as the collective S&P 500, which over the last 30 years has averaged over 10% per year. Not bad at all. So remember, whether you're playing basketball or investing, unpredictability is part of the game. It just happens to be a really big part of the game of investing. So while it's tempting to go out after the next big stock or investing tip, factor in the unpredictability of efficient markets. Know the averages and use them to wisely benefit from your investments. If you're interested in getting started investing in low-cost index funds, then check out this video where I discuss how to do just that. We'll see you there.